Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. And if you guys are looking for undervalued investment opportunities, click subscribe, join the channel, join me on this ride up in this commodity bull market. We can do it together and I can help you out. So today I'm going over real estate and ratios, how they tie together. And I'm going to give you a ratio example so people kind of better understand why I use this. It's based in logic. And if you take like an IQ test or something like that, sometimes they put on there, or like test IQs, they'll put like a logic question. Like if all zips are zoodles and half of zoodles are something else, orangutans, then half of zips are orangutans. It's just a straight logic thing. And I'm just going to touch on something. Using ratios is just using logic and then finding correlations in time. And in all honesty, you don't need to know what the necessary causes are. If the indicator has a high reliability of 95% or 100%, what we look for is we try to find data in history that correlates very well. And if you find data that correlates almost to 100%, which it does, you take the ratio and correlate it to the housing starts, it correlates 100% of the time, going back 50, 60, even 100 years. So they are reliable indicators. If it's a reliable indicator, you don't necessarily have to know all the reasoning of why these things tie together. You can come up with a bunch of reasons, but you don't necessarily know that it's 100%. It could be a million reasons. Whatever those reasons are, we have the indicators. They are reliable. That's what I look for. And eventually, I think it will make us money. So let's jump in here. I'm going to show you a couple of things. I'm just going to shrink myself up. So what I have here is the S&P Case-Shiller U.S. National Home Price Index. And this is probably what people are looking at. They're probably saying, look at that. It's way higher. What's going on? It's in a bubble. All I want to say is this. This thing's gone up quite a bit, right? It's going on up. And if you look at the last bubble here, what first happened is this thing has to turn, and it went sideways for a little bit. And then it went down. We don't see in history, even here, if you were to look at history, you don't see these things just go up and then just massively go down out of nowhere. We are in a very strong uptrend here. And I don't know how long this is going to last. I would say it's probably going to last longer than what most people think. Now, I don't know if this rate of increase is going to last as long as we think it's going to. Maybe it kind of turns down a little and it goes more this way instead of straight up. But there's always a turning point where things happen. And inventory basically moves first before prices move. And this is an aggregate. So inventory goes up before prices go down or go sideways. So inventory has to move substantially higher for the price to level off and start to turn. I've got inventory here. So I pulled up inventory because we know prices are going up quite substantially. Inventory here. This is the housing inventory, the active listing count in the United States. We were at 1.6 million back in 2016, which is actually pretty low. And we've continued to eat through the inventory listings all the way down to what I think is an all-time record low of only 500,000. That is little over 1 month of inventory for housing inventory. And this one is January 2021, and it goes past it. So this is the lowest that we've ever seen. So what you would expect is the highest increase in prices that we've ever seen. And I think that correlates very well. Now, in order for a crash to happen, this has to go up. And homes aren't just going to come into existence. Last market where we had this crash, we had a double whammy. We had foreclosures come on, and inventory was stacked to the brim with brand new houses being built. At the top of this, we were building 2.2 million homes per year. We were about 1 million homes over what the average is over here, a little bit less than 1 million homes over. And we did that for a long period of time. We overbuilt in this entire scenario, which created a new problem. This inventory was created, this low inventory was created from this yellow area under the curve that I created right here. And that yellow area under the curve is the housing deficit. We should have been building on average where this red line is. And when you overbuild a little bit, you're going to create excess inventory, which then will get worked off a little bit over time. So a little bit of this is excess inventory that's getting worked off in here, and a lot of it is new homes that weren't built. It's the combination of those two things. And what we calculate, if you were to look at articles and you were to look at real estate analysts, is that we are 3.8 million homes short in the real estate area. That's how many homes we should have built that are new, and we didn't build those. So really, we have the largest home deficit that we've ever seen. And what I have here in these red arrows, those are the red arrows for a commodity boom. This one spans over two real estate cycles. We had a housing boom here, a housing boom here, and a housing boom that's coming up. These are all inflationary times. They all had increasing interest rate environments, and they all had commodity booms. Every single one right here. Now, another thing that we can look at are ratios. This is the gold to oil ratio. When the ratio is above 30, we should be buying the living heck out of oil. When the ratio goes below 10, we should be looking to sell our oil. These are the real estate market booms overlaid on top of the oil to gold ratio. Do you see a correlation here? Every single time we have a real estate expansion phase, what do you see in oil prices? They contract. They outperform gold every single time we go into one of these things. And this blue star is where we are at today. We are still incredibly cheap, just under 30. Incredibly cheap. That's your correlation here. This is correlated to the uranium to gold ratio. This is the correlation here. This is just slightly delayed behind. Okay, so 73, let's correlate it right here. 73 is about a year behind this beginning of the expansion phase. So there's a slight delay behind the expansion phase by about a year or two. And we are going into an expansion phase now in 2020. And guess what? A year or two delay puts us at 2021, 2022 for uranium price movement. Correlates very well. Now, is the uranium price moving because of supply and demand? I'm going to say no, it's not. What's really driving this, unless you get far out of whack, what's really driving this is inflation. Now, supply and demand is going to pile on here. I do think that supply and demand for uranium is a little bit different because it takes so long to react to the imbalance. So what I think is going to happen is you're going to have a double whammy come up where supply demand goes into a shortfall and you have the inflationary tailwinds behind you. This is going to be a big bull market in uranium. The blue star is where we are at today. We've never been this cheap. It's over 60 pounds uranium to 1 ounce gold. Now, I'm going to go and do a ratio example. This is just straight logic. All right. I don't need someone on another channel to say, well, it's not going to happen. Why are you comparing a commodity to gold? Gold doesn't mean it. Guys, it does. Gold is money. Money is what you price assets in. Do you price it in fiat currency paper that you don't know the value of? No, you don't. You put it in money, and then you use that against history because that's what we had as money back in the 1800s, 1900s, early 1900s. So how do you compare something where they're manipulating this dollar, throwing dollars all into the system? What's the real inflation rate? No one knows. Why use that? Just use gold, which is a stable commodity. Now, if gold goes through the roof, all these commodities are going to go through the roof. I mean, they're going to do very well. Now, here's the example. This is what I'm comparing are two ratios. And from ratios, I derived this kind of format that A is greater than B because of the ratio. B is less than C, which means B is cheaper than C. C is more expensive than A, D is roughly the same price as B, and E is greater than C. Okay? So in history, we track the ratios just like we did here. Right here, if gold is A and oil is B, B right here is cheaper than A. Anything around this line is saying that B is cheap. Anything on this line is saying that A is cheap and B is expensive. Now, what you do in history is you just look at these different assets and you compare them to each other. All that is a logic IQ game. IQ if you want to do it very fast. But so A is greater than B, which means B is cheaper. If B is cheaper than C, that could mean that C is greater than A, or A could be greater than C, but we know that B is definitely cheaper than A and C. If C is greater than A, then we know that C is expensive to A, and B is really cheap because B is cheaper than A. So if C is more than A, if C is expensive to A, and B is cheaper than C, and B is cheaper than A, B is by far the cheapest right now. If D equals B, then D and B are cheap in compared to history. And if E is greater than C, then E is the most overvalued. We can consider that tech stocks or stocks. Now, in history, irrespective of the reasons why, does not matter why. All right? Get that out of your head. We don't need to know all the reasons of why. If you use this logic and these things are repeatable, if every single time we go from a cheap phase to an expensive phase during a certain market condition, and we use logic, we think for ourselves, what is the highest value letter in here? Well, it's E. What is the least value letter? D and B. Those are the two cheapest that we know of. So if you're going to invest, what would you do in this scenario? Well, you would go into D and B. Straight logic. It's the cheapest one. And if ratios maintain this 30 to 10 ratio throughout time, and every time you enter an expansion phase of real estate, it goes down, well, that's just easy. You've got your timing and you've got your value. Now, if someone says, well, this ratio doesn't matter, I'm going to say that it does matter. In fact, this matters more than anything else that you can look at. This is telling you what's cheap and what's expensive, and the real estate overlaid on this gives you your timing. So if someone says that there's no relationship between uranium and gold, and I don't care who it is, they are wrong. There is a relationship, and you can create relationships however you want. Because guess what? Logic is always right. It isn't wrong. If there's a reliable indicator, if there's something where X always turns down when Y goes up, and it has an R squared value, and R squared value is how well the data correlates to each other. If it has an R squared value of like 95%, that's pretty strong. I mean, that is about as strong as you can find. If you have data that correlates to each other and you have a bunch of different data and the R squared value is incredibly high, all over 90%, and then if you correlate three things deep, which makes it 95, 95, 95, which is basically a sure win, you use that for logic. You use that for investments and key points and your timing. You don't need an economics degree to do this. You just have to be somewhat smart. That is it. Now, this isn't going to tell you what the ride's going to be like. It can be one hellacious ride, riding up and down, and be very choppy in the short term. We just know that D and B are the cheapest, and that our timing is right with the real estate overlaid on all of these charts. Now, I'm going to go through some givens here, and I'll read the givens, okay? This is the given that I'm proposing here. Every time real estate increases in price, more homes are built. More new homes built increases the M2 money supply. These are what I've seen in history, and I consider to be facts or givens. More M2 money supply increases inflation with a slight lag, about a 1 to 2 year lag. Every time interest rates increase, stocks go down. High growth stocks, I should say. Every time inflation goes up and interest rates go up, commodities go up. Demographics increases demand for real estate. Real estate goes up and down based off of inventory and supply-demand characteristics. That's the given that I've looked at in history. Those are the correlations. So what I've done for a conclusion is with this given, I've jumped to a conclusion. Conclusion: demographics determines inflation through real estate. Larger demographics results in higher interest rates. Larger demographics results in commodity booms. Interest rates causes a rotation of money from bonds and stocks into commodities. Because guess what? Interest rates lowers the price or the price to earnings ratio of stocks. Therefore, they have to be sold. Because if earnings remain roughly the same, the price has to go down in order for the PE ratio to shrink. That's the conclusion right there. That's the correlations with the ratios, the correlations with real estate and inventory and prices. So what do we do if we're at record low inventories? What do you think price is going to do in the housing market? We've never been this low. What do you think it's going to do? If we put a scatter plot, which I've done before in some videos, every time you reach below 6 months of inventory, real estate has gone up 100% of the time. If that's the case, and we're at 2 months of inventory, where do you think the price is going to go up? 100% up. It's never gone down in history when the inventory has been this low. 100% on that scatter plot when it's gone under 6 months. Now, that means that inventory has to increase to above 6 months of inventory for the chance, between 6 and 8 months, for the chance of it to go down or go flat. This is just statistics. If you guys want to go to other channels and listen to their non-data opinion, go for it. This is what I look at. The statistics behind and the data behind all of this. This is what's going to make you a better investor. It's going to make me a better investor. And remember, it's not going to make you immune from short-term movements that go up and down. This is for a long-term, big picture approach. If you look at some of these ratios, this is the oil to gold ratio that I'm showing you. It goes up and down through here. What you do is you can buy it here cheap, goes down, comes up, you buy it again cheap, and then you ride it all the way down and sell here. It doesn't mean the ride's going to be easy. Doesn't mean it's going to be in a year or two. You may have to ride this thing back up and down all over the place. I'm not saying it's going to be easy. You're going to have to know this inside and out to have the conviction to hold on. This ride here went all the way down and it popped up and then eventually went lower. There's movements in here that you could potentially want to sell out. It's not going to be an easy ride. But this gets you in the right ballpark. It gets you looking at the right sectors. It gets you in the right mindset. It gets you the right timing. Real estate does. So if what I see is so many indicators aligning, and it's not just these, it's like all of them. They're all aligning for a commodities boom. Copper to gold ratio, platinum to gold ratio, oil to gold ratio, gold to money supply, gold to real estate, gold to stock ratio, stocks to real estate ratio. Interest rates are moving in the direction of up. It goes on and on. And what is the Federal Reserve trying to do? What are they trying to do? They're trying to hold rates down. Well, why is that? Why are they trying to hold rates down? Why would anyone in their right mind go into bonds when the government is trying to hold things down? Because if they lose control of it, where do you think it's going to go? It's going to go up. And why are bonds going up? Something's influencing bonds to go higher, which is called inflation. It's all aligning. Now, will I change my stance if something happens? Sure. On the short term, I could say, yeah, we could see a pullback here. And I'm not saying that we're going to see a pullback right now. I'm just saying if the data changes, I will change my mind. Right now, everything, I've never seen more of a go in all of this and a better alignment ever. So I'm sticking tight. I'm doing these clips for you guys to understand. I'm doing this from a big picture perspective, and it's based off of logic. It's not based off of opinion. It's based off data, logic, and it's just simple things where if this is greater than this, and if this is greater than this, and if this equals this, this is the cheapest asset. We should be here based off of history and based off of what I see in terms of the cycle of real estate, the business cycle. If this interests you, click subscribe to the channel, give me a thumbs up, and thank you for listening. This is Finding Value.